So welcome to Jumbo IS and welcome to our lecture series called Prelims Powerplay. In this lecture series, we cover all the important topics, all the important news items, all the important current affairs from the past 1 year for your prelims examination this year. Now, the thing is, we have divided all these important current affairs into subjects, and we will cover each and every subject one by one so that you secure your prelims examination this year. Now, we have started with important topics from economics. Okay, the past two lectures were dedicated to economics, so we will continue with that lecture series. Okay, so the third lecture today, which is lecture number 3, we are going to talk about important topics from the subject of economics. So let's continue with that. Let's start today's lecture because I know time is of the essence for you guys. Not much time is left in prelims examination. Time is of the essence. So let's not get ourselves bothered with introduction. Let's straight away jump into the lecture. All right. So let's start. So prelims power play. Okay. Economic section. Now, as you all know, that the entire topic of economics has been divided into these subtopics, or the entire subject of economics is divided into these subtopics. We have covered economic growth and development in the previous two lectures. Today we are going to begin with banking and finance. Okay, so let's start with banking and finance and what topics we will discover from banking and finance. So here's the list of topics from banking and finance which we are going to cover through these lectures. Okay, number one topic which we'll cover today is deposit insurance. Okay, then number 2 topic is about sovereign green bonds. Very important, and chances are that an MCQ might be framed from this topic in your prelims examination this year. So pay close attention to this topic. Then Securities and Exchange Board of India's when listed platform. We'll talk about this. Then credit score and RBI. Recently RBI gave a directive to credit information companies with respect to credit score updation of customers. So what is credit score? Why did RBI give this directive? We'll talk about this. Then there has been slowdown in deposit growth as reported by Indian banks. We'll talk about this. Then Jan Dhan Yojana completed 10 years. So we'll talk about this. Then we'll talk about two projects of RBI. One is Unified Lending Interface and Project Nexus by RBI. So these are the topics that we will focus our attention on. Let's start discussing them one by one, starting with deposit insurance. Okay, so deposit insurance. The thing is that we all make savings. Okay, we all have savings, and most of us deposit our savings in banks. But the reason why we deposit our savings in banks is because we think that our money is safe in banks, right? That is the reason why we deposit our savings in banks. But what if I tell you that it's not that safe? The thing is that what if the money that you have deposited in your bank, what if that bank becomes bankrupt? That bank closes down. Now, if that bank closes down, so would your deposit. That is the risk you run. Yes. Now, everyone knows about this risk. Okay. Still, people deposit their savings, most of their savings, in banks. In fact, people deposit their savings in all sorts of areas, but they consider banks to be the safest. Now, why are banks safe? The thing is, banks provide you with deposit insurance. Your deposit is insured. Even if that bank closes down, still you'll get your money back. Even if that bank closes shop, still you will get your money back because your bank account has been insured. You know about insurance, right? So your bank account has been insured, your savings have been insured, and therefore you will get your money back. But there is a limit up to which you will get your money back. That limit is 5 lakh rupees. So if you have up to 5 lakh rupees in your bank account, you will get your money back. But if you have 10 lakh rupees deposited in your bank account, well, you'll only get 5 lakh back because that insurance is up to 5 lakhs. Now, back in the day, it was up to 1 lakh. Then Government of India increased it to 2 lakh. And recently, Government of India increased it to 5 lakh. Now, government is thinking to increase it even further. Right? And that is why this topic was in the news. So we will discuss deposit insurance, and the nitty-gritties related to it from which an MCQ might be framed and feature in your prelims examination. All right, so let's talk about deposit insurance. Now, the thing is that your deposits, okay, in different banks, mind you, I'm only talking about banks, okay, not anywhere else. Your deposits are insured and insured up to rupees 5 lakh. So, if a bank closes down or becomes bankrupt, you have a guarantee of at least 5 lakh rupees. If you have only 2 lakh rupees deposited in your account, you'll only get 2 lakh. But if you have up to 5 lakhs, you'll get all your money back. If it is more than 5 lakh, then minimum you'll get 5 lakh because your savings account is insured. Now, you all are familiar with the term insurance, right? Insurance is done by an insurance company. And when you get your car insurance done, house insurance done, medical insurance done, all these insurance things or insurance you do, right? Now you go to an insurance company and go for this insurance, whether it's car insurance, house insurance, medical insurance, and whatnot. Okay. And this insurance company asks for premium. Premium is the money you pay every year so that you get that insurance facility. So let's talk about medical insurance. So you pay an annual premium, some money every year to this insurance company. An insurance company says that in future, if you have any medical expense, we will cover for it, right? Similarly, deposit insurance also functions in a similar way. There is a company that insures all the banking deposits and it is called DICGC, Deposit Insurance and Credit Guarantee Corporation. Okay. Now, this company insures your deposits. Clear? Now, for that, it should also ask for a premium because every insurance requires premium to be paid, right? Now, your bank accounts or your savings in your bank accounts are insured by DICGC and DICGC receives premium. But the responsibility of paying that premium is not with you, is with the banks. So banks pay this premium on your behalf. Okay. You don't have to bear any responsibility, any financial responsibility also. This premium doesn't go from your pocket, your savings. It goes from bank's pocket. Okay. And the reason for providing this insurance facility to your saving deposits is, well, the reason is very simple: to improve public trust in banking so that more and more people feel secure that their money is safe in a bank. Therefore, more and more people will deposit their money in the banks. And if more and more people deposit their money in the banks, well, then banks will have more money to loan out from. Because after all, banks use your deposits to give loans. Now, if banks will have less deposits, then it will give less loans. That would lead to economic loss. That would hamper our economic growth, right? So public trust in the banking system is very important because if that is there, then more people deposit their savings. Banks have more money, they are flushed with liquidity, and they can give out loans because of that, which will help the economy. Okay, this is deposit insurance. Now, I'm hoping that you understand the overall background regarding deposit insurance. Now, let's understand some details. Okay, all right. So, as far as deposit insurance facility goes, this deposit insurance facility is provided by Deposit Insurance and Credit Guarantee Corporation. I'll explain to you what credit guarantee over here means. But for now, just understand it is provided by DICGC. Now, DICGC was established under DICGC Act of 1961. That means it is a statutory body established under a law of parliament. Okay. And it is a wholly owned subsidiary of RBI. Simple. Now, the deposit insurance is rupees 5 lakh per depositors. And which types of banks are covered by DICGC? So it covers all types of scheduled commercial banks, regional rural banks, local area banks, and cooperative banks. Okay, so all these types of banks have deposit insurance facility provided by DICGC. Remember, the responsibility of paying premium is with the banks, not with you. So you are off the hook as far as premiums are concerned. Okay. Now, what type of deposits are insured? Okay, you need to know this because an MCQ might be framed. So all savings deposits are insured, FDs, fixed deposits, current deposits, and recurring deposits, RDs. FD, RD, account, current account, all of them are insured. Which deposits are not insured? So deposits of foreigners in Indian banks, they are not insured. Deposits of central and state governments. For example, central government or state governments also have deposits in banks, SBI and all. They won't be insured. Okay. And interbank deposits. What do you mean by interbank deposits? Sometimes SBI has a deposit in ICICI. Okay. ICICI might have a deposit account in SBI. These are not insured. Okay. So who are protected? Not banks, not governments, not foreigners. People like you and me are protected through this deposit insurance scheme. Okay. Now the thing is, when we talk about FDs, you deposit your money in a fixed deposit account and you also receive an interest on it. A question might be asked whether interest is also protected under DICGC insurance. Yes. The amount you have deposited and the interest you have earned on it, both are protected. And in case a bank fails, DICGC will give you your money back within 90 days. That is its statutory requirement. Simple. All right. Now, what are the advantages of this? Okay. First of all, it increases public trust in the banking. So more and more people will deposit their money. It would improve or protect depositors if a bank fails because of its own mistakes. It's not the fault of the depositors, so they should be protected, right? Now, because people have more trust in the banking system, well, they save more in the banks. Banks have more money to give loans from. Therefore, it also promotes credit availability in India. More and more people can get access to loans to boost economic activity, right? And it also ensures financial stability because people's trust in the banking system is high. Make sense? Simple. Now you need to have some information with respect to DICGC also. Okay, so what is DICGC? So DICGC, as I've told you, was formed under DICGC Act of 1961. Now in 1961, there were two organizations established. Deposit Insurance Limited, Credit Guarantee Corporation Limited. In 1978, these two organizations were merged together and DICGC was born. Remember, it is completely owned by RBI. Now the thing is, we all know what deposit insurance is. What is credit guarantee? Which is featuring, these two words are featuring in this organization's name. What is credit guarantee? Like your deposits are insured, similarly loans are also insured. Because while giving loans, banks are also running a risk. Banks give loans. Okay, let's suppose a bank has given me a loan. What if I don't return that money back? That can happen. People default on loans. So banks also need to be protected. Therefore, Deposit Insurance and Credit Guarantee Corporation actually insures the loans also so that banks are protected. This is known as credit guarantee. It is the guarantee that often provides for a specific remedy to the creditor if his debtor does not return his debt. Okay, if a loanee defaults. All right. Now, DICGC has three funds: deposit insurance funds, where all the premium for deposit insurance is collected; credit guarantee fund, where all the premium for credit guarantee is collected; and a general fund. Well, general fund is to meet operational expenses because DICGC will have an office, it will pay salaries to employees, it will pay electricity bill, water bill, and whatnot. So for operational expenses, there is, well, general fund. Okay, ignore this for now. Niti Aayog and all, we don't need this. All right. And that would be all as far as deposit insurance is concerned. Now let's shift our focus to second topic of the day. Let's quickly shift to second topic. And that second topic is sovereign green bonds. Sovereign green bonds. Okay. Now you see, climate change is a reality, right? And climate change really makes the entire humanity vulnerable because if our Earth's climate is going to change drastically, it really impacts us. We all know global warming is a threat. Therefore, we need to do something about global warming. Now, what is that something? Well, we need to stop emission of carbon dioxide in the atmosphere. That happens through burning of fossil fuels, through a whole lot of things, right? So to prevent global warming, we basically need to shift to solar, electric vehicles and other green technologies, right? So the entire humanity, the entire human civilization should shift towards green technology so as to prevent global warming. We all know about it. But shifting to green technologies is expensive. Okay? It requires a lot of money. Now, money is really needed if we really want to make this green transition. Now, where will this money come from? Now, there are many instruments through which you can raise money for green transition. One such instrument is sovereign green bonds. So, sovereign green bonds are those instruments, basically debt instruments, through which you can basically access finance for green transition so that global warming can be protected, people can be protected from climate change, right? Now, about sovereign green bonds, okay? To understand what sovereign green bonds are, first of all, you need to understand the meaning of each and every word. This sovereign green bond concept consists of three words: sovereign, green, bond, right? So you need to understand each and every word so as to understand this entire phrase. Yes? So I'll unpack each and every word for you. Okay? First, let's start with what is a bond. Okay? All right. Hear me out carefully. I'm explaining this entire topic from basics. Okay? Now, what is a bond? Suppose my name is A and your name is B. You have a lot of money. I don't. I require 100 rupees right now. I don't have money. I require 100 rupees for many things. I have a lot of expenses. So I need to borrow 100 rupees from you. Okay? Because you have a lot of money. You're B. You have a lot of money. You are ready to give me that money. Okay? So I come to you and tell you, please lend me 100 rupees. Okay? And the thing is that I will return this money to you after 1 year with 7 rupees interest. So I will give you in total 107 rupees back. So you give me 100 rupees now. After 1 year, I will give you 107 rupees back. You won't be at a loss. I would get my requirements fulfilled, needs fulfilled, right? So you become ready. All right. Now, your problem is that, okay, you are ready to give me 100 rupees, but, well, very simply put, how would you trust me to return this 107 rupees back to you? Okay, what if I run away? What if I after 1 year, when you come back to me, I say, when did I borrow money from you? I can do that, right? So what do I do? What do I do to instill trust in me? So I will print a piece of paper. Okay, I require 100 rupees, right? So I will write 100 rupees. Okay, I need 100 rupees from you. For how much time period? For 1 year. Okay, I will return 107 rupees back to you. Okay, so I'll write 107 rupees. Clear? Now I will print this piece of paper and give it to you. Okay, this piece of paper is proof that I have taken money from you. I will sign this piece of paper. Okay, so after 1 year, when you will come to me, you'll have to just show this piece of paper to me and I will give you 107 rupees. Whoever will come to me and show this piece of paper, I will give them 107 rupees, plain and simple. Now, this piece of paper is nothing but a bond. And through this bond, how are you benefiting from this bond? How is B benefiting from this bond? Well, B is giving 100 rupees. After 1 year, is getting 107 rupees in return, right? So B is basically gaining 7 rupees. This gain of 7 rupees is known as yield. Yes, makes sense? This is known as yield. So yield of this bond, this piece of paper, is 7 rupees. So for the yield of this 7 rupees, B is ready to give 100 rupees to A. So simply put, bond is a debt instrument. You raise debt through it. Clear? Simple. So now you understand the meaning of the word bond? Yes? Now, the thing is, and hear me out carefully, because this is important. Let's suppose this transaction between A and B. B gives 100 rupees and gets 107 rupees in return after 1 year. This transaction through this piece of paper which is known as bond. Right? Now B will have to wait for 1 year to get his or her 107 rupees back. But what if B needs money after 6 months? What will happen then? What if B needs money after 6 months? What should you do then? So B will find a third person called C and tell him that you take this piece of paper from me. Whoever will show this piece of paper to A will give them 107 rupees. Yes? So you take this piece of paper from me. C will say, yes, I would. But B would say that in return, you have to give me 103 rupees. Give me 103 rupees, I'll give this piece of paper to you. Now C will be interested. Why? Because C is giving 103 rupees for this piece of paper, and after 6 months, C will get 107 rupees from A. So C stands to gain. B also stands to gain because B invested 100 rupees and now is getting 103 rupees. Yes, simple. Now what if C requires money after 2 months? What if C can't wait for 6 months? C requires money in another 2 months. C will sell this piece of paper to D. What if D wants money? D will sell it to E, F, G, H, I, J, K, L, M, N, O, P, Q, R, S, T. Okay. So you can sell this piece of paper till it gets mature. Okay. Anytime you want. Clear? Now just remember this fact. When B bought this piece of paper, when B got this piece of paper from the issuer of this bond, that is A, this was known as primary market. So when you directly buy this bond from the issuer of the bond, that is primary market. Now B sells it to C, C sells it to D, D sells it to XYZ. Okay? These transactions are called secondary market. Okay? So secondary market is when C buys it from a third person, D buys it from a third person, not from the issuer. So primary market, secondary market. You're clear? Now secondary market is important because if secondary market didn't exist, then B wouldn't have been that ready to give 100 rupees to A. Because B would have thought, what if I need my money back in 3 months, 4 months, 5 months? I have no option. I'll have to wait for 1 year. Okay. So if there is no secondary market, there is problem with liquidity. What if B needs money quickly? Right? But because there is a secondary market, B is assured that whenever he wants to get his money back, he can sell this piece of paper to any third party and he will get his money back with some gain. Right? So secondary market is important for increasing the attractiveness of this piece of paper. Simple? Okay? Clear? So now you understand, you have a basic understanding of this word bond. Now let's try to understand other two words also. Okay? All right. Now A issued this piece of paper to borrow money. Okay? Right? So A issued this bond to borrow money. Now he was able to borrow money. Now if A uses that borrowed money to fund or finance green projects, projects that will fight against climate change, projects that will stop global warming. Okay, we'll call them green projects. So if A uses his borrowed money through this bond to finance green projects, well then this bond will be called a green bond. All right, simple. So when you raise money through a bond to finance green projects, that is known as a green bond. Very simple. And if this A is not a private entity, it is government. So if government is issuing this bond, then we also add the word sovereign. Sovereign means supreme lawmaking authority. That is the government, right? So a sovereign green bond is that bond which is issued by government to finance green projects. Simple? Yes, because government also needs money to fight against climate change. This is what a sovereign green bond is. Now, the reason why this sovereign green bond was in the news was because it said that sovereign green bonds issued by Indian government are not that attractive to global investors. Okay, that is why not many global people are buying sovereign green bonds. That is why India is not able to raise that much money to finance green projects. Therefore, we need to do something to make these sovereign green bonds of India attractive so that India raises more and more money and go towards green transition. That was in the news. Okay, that is why sovereign green bonds were in the news. So let's talk about these bonds. Okay, I have explained everything. So, what are sovereign green bonds? These are debt instruments issued by governments to fund environmentally sustainable projects. In India, these are issued as per Sovereign Green Bonds Framework 2022. Just remember this. All the rules and regulations with respect to sovereign green bonds are mentioned in this SGRB framework of 2022. Okay? Now remember, foreigners can buy these sovereign green bonds from India. Now, there are two ways through which bonds can be bought. Okay, B actually bought this bond from A. Yes, B lent money to A. We can also say B bought this piece of paper from A. Yes. Now, foreign investors have the option of buying this piece of paper, sovereign green bond, from government. Okay, but there are two ways, and those two ways are the foreign investor can either pay in dollars for buying this bond or either pay this money in Indian rupees because this bond is issued by Indian government and Indian government requires rupee, right? Now, if this bond is of a category uh, under which now if this bond is a category of bonds which can be bought by using dollars, then we'll call this bond a dollar denominated bond. Now, if this bond is of that category which can only be purchased by giving rupees, so foreigners will first have to convert their dollars into rupees and then buy this bond. Then this will be called a rupee denominated bond. Simple. Now remember, sovereign green bonds of India are rupee denominated. They are not dollar denominated. So foreign investors have to first convert their dollars into rupees and then only they can buy it. All right. So exchange rate risk lies on the buyer of this bond, which is also known as subscriber of this bond, not the Indian government. Okay, make sense? Clear? Now, the thing is, under SGRB framework, it is clearly mentioned that the proceeds of this bond can be only used to finance green projects, right? Now, what are those green projects? SGRB framework clearly gives a list of projects that will be classified as green projects, okay? Number one is any project that will enhance energy efficiency, any project that will reduce carbon emissions, any project that will promote climate resilience, that our infrastructure becomes more resilient to climate change or disasters, or improve natural ecosystem like wetlands, forests, and all that. These are categorized as green projects, and money raised from green bonds can be used to finance these projects. Okay. Now, one more thing. You guys remember that the advantage of buying a green bond for B was that it offered a yield of 7 rupees in that example, right? So yield is the attraction that attracts people to buy bonds, right? Now, the thing is that green bonds, I'll clean the screen over here so that I can explain it to you over here better. Okay, yeah. So the thing is that green bonds are different from normal bonds, or let's call them conventional bonds. Okay, normal bonds, conventional bonds offer higher yield. Okay, green bonds offer lower yield. Let's suppose they'll offer 4 rupees of yield. Conventional bonds would offer 7 rupees of yield. The reason why yield on green bonds is kept lower is because governments need money. But if you increase the increase the yield on that money, okay, then it will become very expensive for government to finance green projects, right? We want governments to have easy finance, easy money to finance green projects because we want to basically uh, fight against climate change. Therefore, you cannot make this borrowing by government expensive. You have to keep this borrowing low cost so that government doesn't have to pay that much interest or yield on getting money for green finance, because you need money for green finance, right? So yield on green bonds are deliberately kept lower so that the cost of these borrowings are low, so that more and more governments issue green bonds, raise money and finance green projects. Okay. Now the difference between yield on conventional bonds and yield on green bonds, right, is known as greenium or green premium. Greenium or green premium. Okay, just remember this. Difference between the yields of normal bonds and green bonds is known as greenium or green, right? So these bonds offer low yield as compared to traditional bonds. The difference between yield on green bond and conventional bond is called greenium. Simple. All right. Now, this article which I'm discussing with you right now talked about the issues with Indian green bonds, Indian sovereign green bonds. What are those issues? Okay. Problems with Indian sovereign green bonds. First of all, Indian sovereign green bonds have low greenium, 2 to 3 basis points. That means 0.02 or 0.03% less yield. Okay, so it offers low greenium. So these bonds have high cost of borrowing for Indian government. That is why Indian government has to pay a lot of yield to get this money for green projects. So it has low greenium as compared to other developed countries sovereign green bonds, which at least offer 7 to 8 bps basis points. So it has low greenium. Then sovereign green bonds of India are not that attractive for global investors. Why? First of all, India does not have a developed secondary market for green bonds. Remember secondary market, I told you. You need secondary market for making these bonds attractive, right? So there is liquidity constraints. You can't sell this bond quickly. You have to wait for the entire period. So that is why investors are a little panicky when they are to buy these bonds. Then investors want to know whether their money is being genuinely used for green projects or not. For that, government needs to have good transparency and reporting standards. Indian government is not that good with that. So global investors are not that attracted towards it. Then domestic investors also don't invest that much. Indian investors do not invest that much in green bonds. Why? Because India does not have impact investment ecosystem. Developed countries have impact investment ecosystems. They have rules which make it mandatory for companies in USA or developed countries to keep a certain percentage of their money in green bonds. So they are forced to buy green bonds. That is not the situation in India. Therefore, there is less demand for green bonds in India itself. So that is the reason. And India issues green bonds of very small size, like 10 lakh rupees, 20 lakh rupees. You need to increase the size of green bonds. You need to borrow more, basically. Okay. Now, what were the solutions proposed? First of all, the author of this article said that instead of green bonds, you should issue sustainable bonds. What are sustainable bonds? Sustainable bonds are those bonds whose money will be used for green projects and social projects. Can be used for social projects as well, poverty alleviation, women empowerment and all. So if your money can be used for green and social projects both, then it will be called a sustainable bond. Then improve your transparency and reporting standards. Promote secondary market so as to make it attractive for investors. Impact investment ecosystem in India. And do partnerships with multilateral banks like World Bank and all, so that World Bank invests in your green bonds, and this will make your green bonds attractive for others, because other investors will think that if World Bank is investing in India's green bonds, then we should also do the same, right? So these are the solutions. All right, make sense? Okay, let's quickly shift to third news item, which is SEBI's when listed platform. Okay, now, SEBI's when listed platform has been issued by SEBI. SEBI is Securities and Exchange Board of India, and it's responsible for share market transactions in India. Just remember this part. SEBI is responsible for share market transactions in India. Like RBI is the regulator for banks in India. SEBI is the regulator for stock market in India. Okay. Now, SEBI found out that there is some issue with respect to IPOs in India, initial public offer. Whenever a company wants to be listed on Bombay Stock Exchange, National Stock Exchange, it issues its shares in the market so that anyone can buy their shares, right? That is done through IPOs. Now, SEBI has found out that these IPOs are traded in the grey market, not formally. So, to stop that, SEBI launched when listed platform. Okay. So what is this gray market? What is when listed platform? To understand this, we need to understand what IPOs are, right? So let's try to understand that. What is initial public offer? So initial public offer is a process where a company whose shares are not in the market, offers shares of its company for general public. When it does that, it becomes public. Okay. So how does it offer the shares of its company for the general public? It issues an IPO. Many of you are familiar with this term IPO. Okay. This transition from private to public ownership is often referred to as going public. So whenever a company releases IPO, that means it has gone public. That means its shares can be traded or can be bought by general public. Okay. Now the thing is, whenever this IPO is opened, people like you and me bid for it. For example, there is the company called XYZ. It has issued its IPO. So you are interested in this IPO. So you will bid for 100 shares of this company. Someone else will bid for 1,000 shares. Someone else will bid for 10 shares, and so on and so forth. Once the window of this IPO is closed, then shares are allocated. So you bid for 100 shares, but maybe the company doesn't have enough shares, so it will give you only 50. Someone who bid for 1,000 shares, he'll be given, let's suppose, 200. Someone who bid for 10 shares, let's suppose he'll be given 8 shares. Okay. So after your bidding, after the window closes, well, you are allocated shares. Okay. Now those shares are allocated on T plus 1 day. Now what is T plus 1 day? T is the day when the window for IPO bidding closes, and plus 1 day is next day. And then this company gets listed on Bombay Stock Exchange, or its shares are open for anyone to buy on T plus 3 days. That means 3 days after the IPO window closed. Now, SEBI found out that it is between these 2 days, it is between this time, 2 days, that there is a lot of share trading in the stock market. Let's suppose the person who bought 10 shares only got 8 shares. He wants to buy 2 more shares. So he will go to this person who has 1,000 shares and tell him, please informally give me 2 more shares. Okay. So this transaction will happen, but this won't be formal transaction. It will be called gray market transaction. Okay. Or curb trading. Right. And this happens a lot because there is a lag between T plus 3 and T plus 1 day. There is a lag between allotment of shares and listing of shares. So to stop that, SEBI has launched when listed platform. Under this when listed platform, this platform will allow official trading of shares between T plus 1 and T plus 3 days. So you don't have to go to gray market or black market. Just go to SEBI's platform and do this. Okay. The advantage of this is it reduces gray market transactions. It allows formal trading. Simple. All right. Okay. And now let's quickly move to topic number 4, which is credit score and RBI. You see, you take loans from banks. Okay. But banks give you loans and you have to pay that money back in installments, right? Now, based on your repayment schedule, Maybe you have defaulted on one installment, two installments, or you have defaulted on the entire loan. Okay. Based on your performance as far as repayment of loans is concerned, you are given a credit score. Now, that credit score is important for banks because by looking at credit score, banks in future will decide whether to give you a loan or not. And if your credit performance is poor, that means you have defaulted on many loans in the past. If your credit performance is poor, any new bank, future bank might refuse a loan to you, or might become ready to give a loan to you, but will say that I will charge a very high interest rate. Okay. This is the advantage of credit score because it gives the bankers idea about the borrower, whether to give him a loan or not, and if yes, what type of interest rate to charge from him. If the person is risky borrower, let's charge higher interest rate. If he's a safe borrower, then let's charge lower interest rate. Now, how is it decided whether you're a risky or a safe borrower? It is decided by your credit score. Okay. And that credit score is given by credit information companies. Clear? Make sense? All right. So let's talk about this credit score and RBI. Now, how does RBI come into the picture? Look, there are credit information companies. Now, banks give loans to their customers, right? Now, based on their repayment schedule, banks share this information, whether this customer A made timely payments, whether this customer B defaulted on the loan. All this information is shared with credit information companies. These credit information companies give a credit score to you, to people like me and you. Now, this credit score is used by future banks to make their decisions on loans. Okay, this is what a credit score is. Now, why is this in the news? Why this topic is in the news? The thing is that many customers have complained that even after, let's suppose I was a customer, okay, I took a loan, I defaulted on that loan. So, bank gave this information to credit information companies. That credit information company reduced my credit score. Let's suppose after 6 months, I paid all my money back. Now my credit score should improve. But I found out that neither the bank nor the credit information company has updated this information that I have returned all the money back. And they have not increased my score. And because they have not increased my score, now future banks are not ready to give me loans, or even if they are ready, they're charging very high interest rates, despite the fact that I've paid back my loan. Right? Now, this is something that customers complain to RBI. So RBI told all these credit information companies and banks that you have to update this information within 30 days of receiving a complaint, and if you don't, then you have to give compensation to this person, 100 rupees per day, 200 rupees per day. That's the thing. Okay, this was in the news. But what is important for you to know is, what is credit score? So a customer's credit score is an indicator of how consistent she is with repaying debts. When a customer borrows money from lenders, the repayment information is sent to credit information companies, CICs. They are also referred to as credit bureaus. Okay. The higher your credit score, the better your chances of securing loans. Higher score means, well, you are very good. Okay. You're not risky with favorable terms. So higher your credit score, the chances are that you'll get access to easy loans and very low interest rate loans because you're a secure customer for a bank, right? Now, RBI has designated 4 credit information companies. Okay. CIBIL, CRIF, Highmark, you have to remember the names of all these 4. Equifax and Experian. So these are the 4 major credit information companies or credit bureaus registered by RBI. The most popular among them is CIBIL, which gives you a CIBIL score. Every bank listens to this CIBIL score. Okay. Now CIBIL gives this score between 300 to 900. 900 is good, 300 is very bad. Any score above 750 is generally considered good. Okay. And you can check your credit score online for free also. Clear? Now, what were the issues? Customers were complaining. Banks and credit information companies do not their info even after a loan default is rectified. RBI has now directed CICs, banks, and NBFCs to speed up data updation and offer compensation if there is a delay in information upgradation. All right, makes sense? Okay, now we have completed topic number 4.